Warren Buffett is famous for his super simple investing rules, but in 2024 he made two moves with his biggest holdings that seemed to completely contradict each other, leaving investors with a bit of a billion-dollar puzzle. So what's really going on here?
And that brings us to the core question, right? For decades, the man has said his favorite holding period is forever. So why on earth did he just sell a massive chunk of Apple, which is arguably his most successful investment ever, while not touching a single share of his old favorite, Coca-Cola? To solve this puzzle, we've got to look a little deeper into his philosophy.
And this slide, well, it lays out the puzzle perfectly. On one hand, you've got him holding every single share of Coca-Cola, an investment he's had since the 80s. On the other, he sells this massive chunk of Apple, the company that basically came to dominate his entire portfolio. To understand why, we first need to really get what Coca-Cola represents for Berkshire Hathaway.
So for Buffett, Coca-Cola isn't just another stock in the portfolio. Nope, it's a fortress. It's really the ultimate example of a company he believes you can and probably should hold forever. And the reason? Well, it all comes down to one key concept. And that key concept is what he calls the psychological moat. Now, this isn't just about, brand recognition. It's way deeper than that. It's about this deep-seated connection that's wired into our brains. It's the simple habit of reaching for a Coke, a habit that has somehow survived wars, recessions, and entire technological revolutions for over a century.
And what's so crucial here is that Coca-Cola's moat is static. Think about it. It doesn't need constant, expensive innovation. The business is, let's be honest, pretty simple. Sell a sugary drink that people love. This gives it true pricing power. They can raise prices year after year and people will still buy it. It's a predictable, defensive business that's almost immune to the chaos of technological change.
And because that business is so simple, it doesn't need these massive, constant injections of cash just to stay on top. Unlike a tech company that's pouring billions into R&D every year, Coca-Cola's profits are real, free cash flow that can go directly back to the shareholders. And check this out. Here is the result of all that beautiful, simple cash flow. Berkshire gets over $816 million in dividends from Coke every single year. It's just a giant, passive cash machine that requires basically zero effort to maintain, the perfect defensive anchor for the entire portfolio.
Okay, so now let's switch gears and talk about Apple. Because Apple was the complete opposite of Coca-Cola. It was a growth engine that required Buffett to break his famous no-tech rule, and boy did it pay off with a staggering 10-fold return.
So how did he justify breaking his own rule? Well, he completely reframed the company in his mind. He stopped seeing Apple as this complex tech firm he couldn't possibly predict. Instead, he saw it as a consumer goods company. He saw the iPhone not just as a piece of hardware, but as the center of an entire ecosystem that creates this incredible customer lock-in, kind of like Coke's psychological moat, but for the digital age.
And this comparison right here is absolutely key to understanding the whole puzzle. Where Coke's moat is static and needs almost no maintenance, Apple's moat is dynamic. Now, it's incredibly powerful, but it requires billions in R&D and constant innovation just to stay ahead of the curve. That dynamism creates massive growth, sure, but also carries risks that just don't exist for a company like Coca-Cola.
Okay, so all of that brings us back to the big question. If the business is so fantastic, why on earth would you sell? And the answer is fascinating. It's not that Buffett lost faith in Apple at all. It's that he was practicing some really smart, prudent risk management after this incredible run of success.
The first problem, and this sounds crazy, was that Apple was just too successful. I mean, it had grown so much that at its peak, it made up over half of Berkshire's entire public stock portfolio. Just think about that. That's a huge concentration risk. When one company becomes that dominant, a single piece of bad news could have a devastating impact on the whole enterprise.
So the decision to sell wasn't just some gut reaction. It was a really thoughtful, multi-layered strategy. We're talking about managing valuation, hedging against new risks, building up a massive cash war chest, and even, get this, planning for future tax rates. First up, it was just simple prudence. Apple's valuation had climbed to around 30 times its earnings. After making 10 times his money, Buffett just saw it as a practical, smart time to lock in some of those historic gains. It's the classic move of selling not because you hate the company, but because the price just got too high.
Second, and this is a big one, external risks were starting to pop up. Unlike Coca-Cola, which is pretty insulated, Apple is deeply exposed to geopolitical stuff, especially its supply chain's reliance on China.
And on top of that, you've got regulators in Europe and other places taking aim at the very ecosystem that makes Apple so powerful. These are the kinds of unpredictable risks Buffett usually tries to avoid.
And just look at what happened next. That sale helped boost Berkshire's cash pile to a record-breaking $277 billion. That is a massive war chest, dry powder, as Buffett loves to call it, just sitting there ready to be used when the next big opportunity comes along. It also gives his successor, Greg Abel, maximum flexibility to navigate whatever comes next.
So, you see, this whole thing wasn't about abandoning a winner. Not at all. It was about creating a new kind of balance. And the way Buffett signaled this, well, it's just brilliant.
See, after selling billions and billions of dollars worth of Apple stock, the final number of shares Berkshire held wasn't just some random leftover number. Oh no, it was a message.
The number of Apple shares left in the portfolio was exactly 400 million, a nice, clean, very specific number. And for anyone who's been following Berkshire for a while, that number should ring a very, very loud bell. Why? Because it perfectly matches the number of shares Berkshire holds in another one of its legendary forever companies.
That's right, you guessed it, 400 million. That is the exact number of Coca-Cola shares Berkshire has held, without selling a single one all the way back since 1994. The parallel here is just, it's impossible to miss.
So, what does this all mean? What's the big takeaway? The sale wasn't an abandonment of Apple. It was a right-sizing. It was a deliberate move to transform Apple's role from this high-growth, high-concentration bet into a new, permanent core holding, sitting right there alongside Coca-Cola at the very heart of the portfolio.
And this table just lays it all out perfectly. You've got Coca-Cola as the defensive anchor with its static moat, and now you have Apple as the right-sized growth core with its dynamic moat. They each have different risks, and now they each have a clear, permanent, and totally complementary role to play in Berkshire's future.
Which really just leaves us with one final, big question. By creating this incredibly elegant new balance between the old guard and the new, has Buffett perfectly set the stage for his successors to thrive for the next 50 years? Or are we just witnessing the final, masterful brushstrokes of an investor securing his own incredible legacy?